Welcome back everyone, I hope you're having a great day, and in this video we're going to take a look at 4 dividend paying companies who are currently trading below their estimated fair value according to Morningstar. As we know, 2022 has been a very tough year for the stock market, and the S&P 500 is now down over 21% on the year-to-date chart. So there's a ton of strong dividend paying companies currently on a major discount relative to their estimated fair value. And with many investors believing that 2023 will be a strong year for the stock market, and some investors even predicting a 30% rally next year, now may be an excellent opportunity to purchase these strong dividend paying names while they're still trading below their estimated fair values. So we're going to go over 4 different companies from 4 different sectors of the market. They all provide a growing dividend year after year and all sitting very far below the estimated fair value according to Morningstar, which is one of the more popular rating companies in the investment world. But before we jump into that first stock, I am going to ask you to please hit that like button and subscribe. I'm the Gen Z investor, and on the channel we talk about the stock market, go over any major market news, and of course we track the progress of my personal stock portfolio that has now grown to a value at $155,000, and on the last trading day we were in the green by 2.2% or over $3,400 in one single trading day. So overall, if you like these type of videos, please hit that like button and subscribe. And now we're going to move straight into company number 1, which is ticker AVGO for Broadcom. They currently trade for $449 per share and are down over 12.5% on the 1-year chart. The company is sitting very close to the 52-week low. They're trading with a forward PE ratio of only 12, which is below the overall average forward PE ratio of the S&P 500. They have a dividend yield at 3.65% and a current market cap at $182 billion. So this is one of the leaders in the semiconductor industry. They're growing at a rapid rate, and the overall semiconductor industry as a whole is expected to see massive expansion over the next decade. This article from McKinsey predicts that the global semiconductor industry is poised for a decade of growth and is projected to become a $1 trillion industry by 2030. And right now you can purchase a market leader in the sector for below its estimated fair value. Per this Morningstar report, the estimated fair value per share for Broadcom is at $541. The company currently trades for right around $450 per share, meaning they're sitting at a 17% discount of their estimated fair value at this current point in time. So this company is one of the market leaders in the semiconductor industry. They've been able to grow revenue year after year over the past decade. They've seen rapid expansion in their total operations, and you can currently purchase them for a 17% discount according to Morningstar. And if we take a look at their company overview, in fiscal year 2021, they generated over $27 billion of net revenue and reinvested around $5 billion back into research and development. And what makes this company stand out is their massive portfolio of intellectual property. They currently own over 19,000 patents at the end of the last fiscal year. And if we take a look at the financial metrics, they seem spectacular. Year after year, the company expands total sales to over $27 billion per the last year, and we can see year after year some massive expansion. And usually as companies expand their scale, their margins tend to decrease. But Broadcom is the opposite. The company's been able to expand their gross margin to over 74% as of the last year, which is absolutely incredible. Adjusted EBITDA continues to grow rapidly, and my favorite metric when evaluating a dividend company is their free cash flow, and that continues to reach record highs of over $13 billion in the last full fiscal year. And if we take a look at their dividend, they've offered a CAGR of over 43% during the past 6 years. The company's dividend grew from $1.94 per share per year to over $16.40 in fiscal year 2022. So the company has seen some incredible dividend growth. They're generating more and more cash flow year after year, and they're actually distributing that cash flow back to the shareholder in a massive way. And if we take a look at that dividend, they have a nice current yield at 3.65% with a manageable payout ratio of 47%, and the company is currently on a 10-year consecutive streak of dividend growth. And now if we take a look at one more report from analysts, they expect some massive share price appreciation from the company over the next 12 months, and the average of 22 different Wall Street analysts are predicting a 50% share price expansion to $645 over the next 12 months. And even on the low end, these 22 different analysts are predicting some fast acceleration, and the low expectation is still at $540. So over the shorter term, the market is predicting some fast upward momentum in Broadcom stock. So this was the first dividend growth company we're going to take a look at in this episode that is currently trading at a discount or is considered undervalued at their current level. So now if we continue on into stock number 2, we have ticker NEP for NextEra Energy Partners LP. So this is a limited partnership, currently trading for $69, and they're down over 15% on the 1-year chart and are still sitting towards the bottom half on the 52-week range. They have a 4 PE ratio just below 20 with a nice high dividend yield at 4.4% and a market cap at $5.82 billion. And this is another company similar to Broadcom that's operating in a rapidly expanding industry. NextEra Energy's LP is focused on renewable energy, and overall I do believe the renewable energy sector is poised for some major growth over the next few decades, and this company is already a leader in this industry right now, even though it's still in its early stages. They generate power through wind, solar, they have a storage industry, and they have natural gas pipeline capacity. So we can see across the United States they're operational throughout most states. They're continuing to expand their market share in this industry going forward. And overall, throughout the last 5 years of operations, this company's been able to post incredible results for operating in an industry that a lot of companies have failed in. So if we take a look at the Morningstar report right now, this is considered a 5-star company. The estimated fair value per share is at $79, and when they currently trade for $69, that means they're sitting at a 12% discount relative to the estimated fair value at this current level. And if we take a look at some financial ratios, every single year total revenue continues to expand to over $1.1 billion as of the last year. And if we take a look at their cash flows, which is pretty important for a utility company, we can see their cash flow from operations has reached a record high of $778 million over the trailing 12 months. So the company's done a great job of expanding operations year after year and expanding their market share in a fast-growing industry. And if we take a look, they're projecting throughout 2025 earnings per share growth between 6 and 8%, and they even state right here in their presentation, we will be disappointed if we are not able to deliver financial results at or near the top end of our range through 2025. So they're predicting the actual EPS to be around 8% per year going forward. And they have been able to grow their dividend at 10% per year over the past few years, and they do expect annual dividend growth, or the compound annual dividend growth rate, to be above our operating cash flow rate for the next 5 years in the future, and continue to expect around 10% annual dividend growth through at least 2024. So going forward, this company is predicting between 8 to 10% growth for their earnings per share, their operating cash flow per share, and their dividend per share as well. So a lot of strong financial growth coming from this company if they're able to achieve these results. Currently, they do offer a nice high dividend yield at 4.4%, a very manageable payout ratio at 65%, and their 5-year dividend CAGR is at 15%, and they've been growing that dividend for 7 consecutive years. And similar to Broadcom, if we take a look at another analyst report, the average of 15 different Wall Street analysts are predicting over 23% upward movement in the share price over the next 12 months, and even on the low end, they're predicting the share price hit $70, which is right around where we are today, so no downward momentum predicted at all from different analysts on the street right now. So NextEra Energy LP is definitely another company worth taking a look at right now, and it's definitely worth doing some research into if you want a player in the renewable energy industry that is a nice high dividend that's projected to grow very well over the next 5 years. So now we're going to continue on and move into the third stock in this video, another company you definitely have heard of before, but you may not have thought of them as a potential investment, and that is ticker SHW, the SherwinWilliams company, currently trading for $207 per share, and on the 1-year chart they are now down over 32% and sitting very close to the 52-week low. The company has a forward PE ratio just above 24, with a dividend yield at 1.15% and a market cap just over $53 billion. And SherwinWilliams is a company I'm sure we've all heard of. Their paint products dominate the market throughout North America, and this company is actually a dividend aristocrat. Before doing some research into the brand, I did not know that. I didn't know this company has such a long history of performance and outperformance of the overall market whatsoever. And if we take a look at the Morningstar report, currently sitting at 4 stars, the estimated fair value per share is at $235. The last close is at $207, meaning the company is trading for 12% below the estimated fair value at this current point in time. And if we take a look at a company overview, they generate just under $20 billion of total sales over the past fiscal year. They have over 61,000 employees, and their products are sold in over 120 countries all around the world, and they own a bunch of different brands other than the flagship SherwinWilliams. And if we take a look, their sales numbers have been incredible. Year after year, they continue to expand to just under $20 billion with a 5-year CAGR of 11%. Adjusted EBITDA continues to grow at a CAGR of 10%. earnings per share at a CAGR of 13.7%, and their net operating cash continues to expand as well by 11% overall. So for a long, historically branded company, a company that's been in operation for over 50 consecutive years, to continue to post double-digit CAGRs, that's incredibly impressive. And if we take a look, they do not like to hold cash. They like to continuously reinvest all the funds they generate, and they're able to do that with modest CapEx investment. Their business operations does not require massive facilities. They already have the existing infrastructure in place, and it doesn't require massive expansion to continue to grow or expand in new markets, and that target is less than 2% of sales. They have 43 consecutive years of dividend growth, which is absolutely incredible, with a target payout ratio of 33%, and their strategic mergers and acquisitions, they've done 12 different deals over the past decade. So not only is the company growing organically with their existing products, they have their eye on the market purchasing other companies they believe will create synergies from their existing brands and the potential acquisitions. So they've done 12 different buys over the past decade, and they've also done a ton of strategic share buybacks, purchasing over 90 million of their own shares back during the past 10 years as well. And if we take a look at the dividend growth, we can see consecutive rapid expansion in the dividend growth to $2.40 per share as of the latest year, and the overall share repurchases continue to expand as well. They continue to buy back more and more stock as the company continues to grow, and even as the average price per share continues to increase, they're able to buy more and more stock as they generate a ton of free cash flow year in and year out. And if we take a look at the total return of SherwinWilliams compared to their peers or the S&P 500, they've shown some massive outperformance since 2016. SherwinWilliams has over 3x'd in the past 5 years relative to the overall market, which would be at around $220, around a double. SherwinWilliams, we can see a massive outperformance during this period as well. And for a company, although the starting yield is on the lower end, it is considered very safe according to Simply Safe Dividends. So if you purchase this company, it's very unlikely they're going to have a dividend cut anytime soon over the shorter or longer term period. And of course, Wall Street is predicting another strong year from SherwinWilliams into 2023. The average expectation is to grow by 29% to reach the average price target of $260 over the next 12 months. So SherwinWilliams was the third company included in today's video, and now if we continue on into the fourth and final undervalued dividend paying company, we have ticker JPM for JPMorgan Chase, the largest bank in North America in terms of total assets, currently trading for $122 per share, with a market cap at $358 billion. This company is now down close to 28% on the 1-year chart, trading with a forward PE ratio of 10.4 and a nice dividend yield at 3.27%. And of course, like all the others, the estimated fair value per share for this company is very, very high at $188. And right now, that means they're sitting at a 35% discount from this relative fair value. So overall, JPMorgan Chase, we can see, is down pretty far below the estimated fair value according to Morningstar. All the other companies were down between 10 to 20%. JPM is now down 35% overall. But if we take a look at their recent performance, from their latest earnings, the company has done very well. They beat on their latest earnings report in terms of EPS and revenue by a significant amount. And overall, going forward, the Wall Street analysts have predicted 19 upward revisions of next quarter's EPS and 0 downgrades. So the existing expectations have also been raised for the upcoming quarter. And if we take a look at the financial performance, total revenues have reached record highs over the past 2 years at over $120 billion, up from around $90 billion where they sat just a few years ago. This bank has acquired more and more customers. With the latest quantitative easing we've gone through over the past few years, there's been more money supply in the market, which has of course benefited these banks as there's more deposits. More deposits allow them to have more funds that they can loan out and earn more interest income off of. And if we take a look at the dividend, which of course many investors are focused on, JPM currently offers a yield at 3.27%. They pay out $4 per share per year with a very, very safe payout ratio of only 33% of their net income and a 5-year dividend CAGR of over 14%. And of course, like all the others, more share price appreciation is expected for the next 12 months of 18% to the average price target of $137, and even on the low end of $118, that's still above where we're currently sitting today. So Wall Street is predicting some upward momentum in JPMorgan for the next year going forward into 2023. So overall, we're going to conclude the video with JPMorgan Chase. That was the fourth and final name we're going to go over. I want to thank you for sticking around all the way to the end. If you enjoyed this video of 4 undervalued dividend paying companies, please hit that like button, subscribe for future videos, and leave a comment down below. I really appreciate you watching all the way to the end, and I'll see you in the next video.